progress.
Good day. In recent months, the Omicron variant has transmitted globally and a major war started in Europe. The economic costs of the coronavirus generally continue to fall as most economies remain open despite the rapid spread of the Omicron variant. China's response to the new COVID-19 outbreak and the sustained invasion of Ukraine by Russia will, however, weigh heavily on global economic growth and contribute to higher inflation. The war has impaired the production and trade of a wide range of energy, food, and other commodities, and will continue to do so for some time. As a result of these factors, the International Monetary Fund reduced its global growth forecast for 2022 to 3.6%. The SARB's forecast for growth in 2022 is revised down from the March meeting to 3.5%, and for 2023 is lowered to 2.7%. The economy of the euro area is also expected to weaken significantly this year and next. For 2024, global growth remains unchanged at 2.7%. Dramatically higher oil, commodity and food prices, additional constraints to trade and finance, and rising debt costs worsen economic conditions for most emerging and developing economies. Although policy settings in advanced economies remain broadly accommodative, policy normalization by major central banks and higher yields have tightened global financial conditions. Investor appetite for riskier assets is weaker, and asset values in major markets have declined sharply. Economies that failed to take advantage of better global conditions or to reduce large macroeconomic imbalances remain vulnerable to currency depreciation and capital outflows. Last year saw the ongoing recovery of the South African economy from the pandemic, expanding by 4.9%. The economy is expected to grow by 1.7% in 2022, revised down from 2% at the time of the March meeting. This is due to a combination of short-term factors, including flooding in KwaZulu-Natal and the continued electricity supply constraints. Growth in output in the first quarter of this year is expected to be 3.6%, stronger than the 3.2% expected at the time of the March meeting. The economy is forecast to expand by 1.9% in both 2023 and 2024. At these rates, growth remains well above a low rate of potential impacted by load shedding and other infrastructure and policy constraints. Investment by the government sector has weakened significantly in recent years, and that of public corporations is forecast to be very modest. Household spending remains supportive as a result of good growth in disposable income, rising asset prices, and low interest rates. Private investment has also proved to be more resilient than previously expected. Tourism, hospitality, and construction should see stronger recoveries as the year progresses. Overall, and after revisions, the risks to the medium-term domestic growth outlook are assessed to be balanced. with potential growth and expected GDP growth revised somewhat lower for this year, the output gap is unchanged over the forecast period. The output gap is expected to turn positive after the third quarter of 2023. Although important commodity export prices such as for coal, iron ore, platinum and rhodium generally decreased in the latter half of 2021, they surged higher with the war. Oil prices spiked to around $130 per barrel in the early days of the conflict. While oil prices currently sit at about $110 per barrel, we expect them to stay higher than we did in March and to average $103 per barrel for 2022, $90 per barrel in 2023, and $85 per barrel in 2024. South Africa's commodity price basket is forecast to rise by 9.5% for the year as a whole, keeping the terms of trade elevated before gradually falling in 2023 and 2024. As a result of these export and import price developments, the current account surplus is expected to reach 2.1% of GDP this year, easing to 0.8% in 2023 and around 0% in 2024. Although fiscal risk has increased on the back of better revenue and reduced borrowing needs, financing conditions remain tight and the yield curve for rand-denominated bonds is steep. 10-year bond yields increased to about 10.3% in late February and have remained around that level. The commodity export price surge also appreciated the value of the currency. The rand has since depreciated strongly from April due to the start of policy normalization in major economies and a slowdown in China's economy. The implied starting point for the rand forecast is 15 rands 88 to the US dollar, compared with 15 rands 41 cents at the time of the previous meeting. As the global economy rebounded from the pandemic, continued policy accommodation and supply shortages increased prices of many goods and commodities. These prices have been given fresh impetus from further transport delays, supply constraints, and food export restrictions. Producer price increases have passed through to wages and consumer prices in major economies. Our estimate for inflation in the G3 is revised higher to 6.3% in 2022 and down to 2.7% in 2023 before moderating to 2% in 2024. The IMF expects global inflation of 7.4% in 2022 and 4.8% in 2023. Oil prices are revised up further for this year, and fuel price inflation is higher at 31.2%. Local electricity price inflation is unchanged at 11% in 2022, 9.2% in 2023, and 10% in 2024. As a result of higher global food prices, local food price inflation is also revised up and is now expected to be 6.6% in 2022 and 5.6% in 2023. Food price inflation is forecast to rise to 4.2% in 2024. The bank's forecast of headline inflation for this year is revised higher to 5.9%, primarily due to the higher food and fuel prices. While food prices will stay high, fuel price inflation should ease in 2023, helping headline inflation to fall to 5% despite slightly higher core inflation. Headline inflation of 4.7% is now expected in 2024. Core inflation is forecast lower at 3.9% in 2022 due to lower services price inflation. Our forecast for core inflation in 2023 and 2024 is slightly higher at 5.1% and 4.8% respectively. Core goods inflation is forecast higher throughout the horizon, while core services inflation is unchanged in 2023 and 2024. The risks to the inflation outlook are assessed to the upside. Global producer price and food price inflation continued to surprise higher in recent months and may do so again. Russia's war in the Ukraine is likely to persist for the rest of this year and may have significant further effects on global prices. Oil prices increased strongly from the start of the war and may rise more as stresses in energy markets intensify. Electricity and other administered prices continue to present short and medium-term risks. Higher diesel and coal prices may result in upward revisions to our electricity price forecast for 2023. Given below inflation assumptions for public sector wage growth and higher price and food price inflation, considerable risk attaches to a still moderate nominal wage forecast. Higher than expected inflation has pushed major central banks to accelerate the normalization of global policy rates, tightening global financial conditions. On balance, and with some exceptions, capital flow and market volatility is expected to remain for emerging market assets and currencies. Alongside currency depreciation, other risks to the inflation outlook, such as elevated food and fuel prices, have been realized. Average surveyed expectations of future inflation have increased to 5.1% for 2022. Expectations for inflation based on market surveys have increased to 5.9%. Long-term inflation expectations derived from the break-even yields in the bond market have also increased. In the near term, headline inflation has increased well above the midpoint of the inflation target band and is forecast to breach the target range in the second quarter. Headline inflation then returns closer to the midpoint in the fourth quarter of 2024, taking into account the policy rate trajectory indicated by the bank's quarterly projection model. Against this backdrop, the MPC decided to increase the repurchase rate by 50 basis points to 4.75% per annum with effect from the 20th of May 2022. 4 members of the committee preferred the announced increase, and 1 member preferred a 25 basis point rise in the repo rate. The implied policy rate path of the QPM, given the inflation forecast, indicates gradual normalization through to 2024. As usual, the repo rate projection from the quarterly projection model remains a broad policy guide, changing from meeting to meeting in response to new data and risks. Economic and financial conditions are expected to remain more volatile for the foreseeable future. In this uncertain environment, policy decisions will continue to be data dependent and sensitive to the balance of risks to the outlook. The MPC will seek to look through temporary price shocks and focus on potential second-round effects and the risks of de-anchoring inflation expectations. Current repurchase rate levels reflect an accommodative policy stance through the forecast period, keeping financial conditions supportive of credit demand as the economy continues to recover. The bank has ensured adequate liquidity in domestic markets and will continue to closely monitor funding markets for stress. Better anchored expectations of future inflation could support lower interest rates and can be realized by achieving a prudent public debt level, increasing the supply of energy, moderating administered price inflation, and keeping wage growth in line with productivity gains. Such steps will enhance the effectiveness of monetary policy and its transmission to the broader economy. That concludes our statement, and at this stage I would like to invite members of the media to pose their questions, and Zayanda will direct the questions to us, and we will distribute them as appropriate.
Thank you, Governor. May I request that we give the media a minute? There aren't any questions yet.
Yes, I also need a minute.
Good.
I think the minute is done.
Just in time, Governor. We've got a question from Pranesha Naidu at Bloomberg. Given the vote split, did the MPC discuss lifting borrowing costs by more than 25 basis points? Her second point, you've revised your headline inflation forecasts higher. Do you still see high inflation as transitionary, or are pressures now becoming more acute? Thank you, Governor. Those are all the questions for now.
Yes, we did discuss increasing rates by more than 25 basis points. And in the final analysis, the decision was to increase them by 50 basis points per measure. And the inflation forecast, do we still see it as transitory? We don't know what is transitory and what is permanent. What we do know is that inflation is currently an issue globally, and we are no exception. We had started to respond to the rise in inflation last year in September, and we believe the pace at which we had been adjusting the policy rate is appropriate for the state of the South African economy and the outlook that we actually face at the moment.
Thank you, Governor. I have a question from Lukanya Mnyanda at Business Day. Previously, the Governor has argued that SA couldn't follow aggressive easing policy pursued by Western peers because conditions were different. Given the inflation and growth outlook in SA, aren't conditions different enough this time to justify a slower pace of increasing rates? I have about 3 more questions from Pranesha at Bloomberg, Governor, if you'll take them.
Is that the only, can you check if there are other other journalists so that we do not go?
No, there aren't any
Okay,
others.
let me deal with the Kanyo's question. The adjustment in the policy stance depends on the conditions pertaining at a particular point in time, the outlook that we foresee over the forecast horizon, and the risks attendant to that forecast. We believe that the adjustments that we have made are consistent with the outlook that we had presented, including the higher inflation now, which is why we are responding a little bit faster than we had in the previous meeting. In this meeting, we are adjusting rates by 50 basis points instead of 25 basis points. But that, even in so doing, over the forecast horizon, we still believe that monetary policy remains accommodative, even if we were to follow the policy rate path that is derived from the QPM. That said, we remain vigilant as the MPC. We will continue to reassess our position based on the data that would be coming, and we will recalibrate policy as appropriate based on the outlook and the risks attendant to it.
Thank you, Governor. The questions from Pranisha at Bloomberg. Is it fair to say that today's decision was driven more by global than domestic factors? Either way, how do you justify such an aggressive move in flagging South African economy in which consumers are already taking strain? Can you let us in on the MPC's thinking when it comes to more hawkish stances adopted by developed market central banks like the Fed and ECB, seemingly weaker Chinese economy as well? How concerned about these factors are you, and how could they affect monetary policy in South Africa? On new monetary policy implementation framework, please can you explain in very simple terms what's changing? What problems are you trying to solve, and when will it be implemented, and do you see the transition taking place in 3 months? I have more questions from Business Day.
No, we will get back to that. Pranesh, I will not attach value judgment on the fairness or otherwise. Suffice to say that you can't say, as the MPC, today we are considering global factors. At the next MPC, we will consider domestic factors. You consider both global and domestic factors at the same time. But you are also contradicting yourself. You can't say that we can't take an aggressive stand, and I don't see how moving from 25 basis points increases to 50 basis point increases is aggressive, and then also turn around and say that, well, the developed world is very hawkish. How is it going to affect us? You can't have it both ways, Pranesha. And so how would the movement in the advanced economies affect us? Well, we have already seen it. We have seen that global financing conditions are tightening. And as global financing conditions are tightening, they are going to affect financing conditions in terms of emerging markets accessing global financial markets. So that we expected to have. Well, what are the channels through which this would affect us? Firstly, is that as global financing conditions tighten, there is a repricing of financial assets globally. And as we had highlighted, we expect that the assets and currencies of emerging market economies will reprice and will actually remain volatile, meaning that emerging markets would be exposed to heightened risks. And as currencies readjust, as we have seen, the currencies of emerging markets depreciate, and that does have a feed through into the domestic price formulation. And as we stated, we look through these things and look for any evidence of potential second round effects, and that is what we would actually be responding to.
Thank you, Governor. We've got a question from CNBC Africa. It's Fifi Peter. Lots has been said about stagflation and recession in the global economy. Can the Governor comment on the two, and which scenario is more probable for South Africa?
And she's asking two scenarios. What are the scenarios that she's?
Stagflation and recession.
Stagflation and?
Recession. Can I add a question from Tuleto Zwane at Business Day? Some have argued that increasing rates by 50 basis points is not the way to go, given that inflation currently seen is supply-side inflation, and that this increase will further choke growth and not necessarily decrease high domestic inflation. Can the Governor comment on this?
Is that the last question?
For now, yes, Governor.
Okay. Before you went back to the things, there was a question about the MPIF. The MPIF is not a subject of this MPC discussion. We can always deal with it. There is a process to deal with that. Put simply, what has changed? At the moment, we are running monetary policy operations based on a shortage system, which means that we make sure that the banking system is having to come to the central bank to to finance that shortage. That takes place on the basis of not an individual bank, but on the basis of the entire system, and that is how the repo rate is then executed. In the new system, we would allow the banks to run particular levels of reserves with the central bank, which basically means we would be running a surplus system. That would be run on the basis of some corridor. We just have a floor for interest rates. That is what we have seen being implemented elsewhere in the world. Now, the question that you then ask is, in this process, then what happens? Well, South Africa is a small open economy. And with respect to the system of running a money market shortage was based on the premise that you are completely closed. The truth of the matter is, with the banks not having access to rent, they can also go and borrow from another window called rest of the world. So they can create rent differently. And so we felt that it is time for us to have a reform of the monetary policy implementation framework, and that is what we have put in place. There is a process. Yes, we are expecting that it would be implemented by July about. We will be running tests. We will be engaging with the sector and doing continuous tests, but also we will be engaging much more broadly. The document has been out there. We have received extensive comments, both domestically and internationally. And if you would like a short course on the MPIF, please do contact. In the document, there are contact people there who will sit you down and walk you through the MPIF. Fifthly, the risk of stagflation and recession. Globally, that is a risk that people are faced with, that the pace at which inflation has risen globally after you have had protracted accommodative monetary policies in the developed world, that in dealing with inflation and having to bring it down to where it is consistent with the price stability mandates of central banks, that some of the countries in the advanced economies might end up in recession in order to deal that. It is more difficult, it is more an art than it is a science when these people implement those things. But therein lies the lesson. That's exactly what we have been warning about, that you do not allow inflation to run unsustainably high, because the cost of bringing inflation from those high levels to the levels that are consistent with price stability have got significant costs. So for the South Africans who sometimes would argue that we can do with a little bit more inflation and maybe we might get a little bit more growth, there is your lesson straight away. High inflation does not lead to higher growth. Instead, it is leading to risks of recessions and the risks of stagflation, that you have got these elevated levels of inflation that even as you try to bring them down, growth is already weak and you might end up in stagflationary conditions. And when you are faced with stagflationary conditions, you are faced with a nightmare as a central bank, because you have got to make very tough decisions. And if you do not act appropriately, inflation might run permanently away from you, de-anchoring inflation expectations, and you are then left with a situation where you are faced with price instability that you do not want to be looking at. Tulelo, these things are supply-side inflation. Central banks respond to demand-side stuff. We do not have much influence on the supply side. But it doesn't follow that if you have got supply shocks, they will not lead to the price effects that are unsustainable going forward if you do not respond. And so that is why we talk about we do not respond to those supply shocks. We will only respond to the second round effects that come as a result of those supply shocks. So make no mistake, we are not responding to the supply shocks to the inflation outlook. We are responding to the potential second round effects that come from those supply shocks. And that is where monetary policy comes to play its part.
This is the last round, Governor. We've got 2 questions from Lukanyo Mnyanda, Business Day. With the inflation expectations on the upside, how concerned is the MPC about developments in labor markets with workers demanding near double-digit increases? Did you make today's decision primarily as an information tool, or do you think the current policy stance will have a material impact on inflation and demand? He adds, there's bound to be political criticism and accusation that the MPC is not sensitive to the plight of workers struggling with higher living costs. What would the governor's response be to this?
Okay, let's start with the last ones. The reason why you have got technocrats running a central bank is precisely to avoid those kinds of political pressures. We have got to respond to the challenges that the economy faces and take an appropriate stance in accordance with the mandate that we have been tasked with by the people of this country. If ever there has to be political pressure on the central bank, it's got to be inflation is rising. Please protect the working people from the ravages of inflation. And as a central bank with a price stability mandate, we see it as our responsibility to protect the incomes of working people by capping the rise in inflation. So the policy stance that we are taking here, we deem it to be appropriate and to be responding to the cries of South Africans when prices are rising. We have got a responsibility to cap inflation because inflation is eating into the incomes of the working people in South Africa. We have got to live true to our mandate, and we will not allow inflation expectations thus to de-anchor. Mkanyo, the inflation expectations had been rising, and we know that in South Africa, inflation expectations are actually very much backward looking. People look at what the most recent inflation reading is, and they adjust their expectations appropriately. And as such, the central bank have got to take a view and adjust and recalibrate its policies to deal with those rising expectations. And back to the question that was raised earlier on that says, but this inflation is from the supply side, there is nothing you can do about it. Well, it might have come from the supply side, but the bottom line is, it is eating into the incomes of the working people. And if it is eating into the incomes of the working people, it is appropriate for a central bank to act and cap the rise in inflation. So, the policy stance that we have taken, we believe, is appropriate for the state of the economy that we are in, and that it is actually risk-based, that looking forward, we believe that we are addressing the risks on the horizon. Should data show that the circumstances have changed, we will then act appropriately. Gentlemen and lady, anybody wants to add anything? Thank you very much, Zianda. That concludes the business of today.